Hi, my name is Jerry Yu, the Family Money Doctor. Thank you and welcome to my YouTube channel. And please make sure to hit that subscribe button when you enjoy the content of this video. Many of you have heard that life insurance is a great tax advantage tool from your banker, from your financial advisor, or from your life insurance agent. But not many people know exactly why and how it's a great tool. Today I'm going to share with you the history of the tax code evolution and how to properly fund your life insurance policy. In the 1980s, many people started to go into a more predictable and tax-favorable path. E.F. Hutton, a brokerage firm, they were generally regarded as the mastermind behind structuring life insurance policy in a way that allowed people greater safety of their money and less volatile rates of return on tax-free basis. See, they began to reposition serious amount of cash into maximum funded life insurance policy for the primary purpose of accumulating their capital on a tax-free basis for goals such as retirement. See, they help clients to take out small life insurance death benefit and putting the most premium allowed. Again, they were taking out the least amount of the life insurance coverage, but putting as much premium as quickly as they could. And then, of course, the IRS came in and challenged what was being done. And E.F. Hutton then went to the court and they won the case. See, they were in complete compliance with the Section 72E of the Internal Revenue Code. Since the 1980s, the tax law and tax code related to universal life insurance have changed and evolved over time. And since taxes have been a profound impact on your wealth accumulation, it would be wise for you to really understand these key tax codes: TEFRA, DEFRA, and TAMRA. The legislature passed the Tax Equity Fiscal Responsibility Act of 1982, known as TEFRA. See, 2 years later, the government passes the Deficit Reduction Act of 1984, known as DEFRA. See, under these laws, the TEFRA and DEFRA corridor was established. What that means is this corridor dictates the minimum amount of death benefit required based upon the insurer's age, gender, and health. So to accommodate the aggregated premium basis allowed into the life insurance policy. If a policy doesn't comply with the TEFRA and DEFRA corridor, then that will exceed the definition of life insurance. See, that policy will no longer get to enjoy the tax-free status of the Section 72E of the Internal Revenue Code, nor would it allow clients to access their money tax-free under the Internal Revenue Code Section 7702. Now, more and more Americans still see the value behind putting their money into these type of accounts. And when this was happening, banks and credit unions began to complain. And in response, the government passed the Technical and Miscellaneous Revenue Act in 1988, also known as TAMRA. TAMRA slows the amount of money goes into a universal life insurance contract. Simply put, the TAMRA citation policies after June 21st, 1988 no longer will fund a maximum single premium under the maximum TEFRA and DEFRA guideline. See, those policies will no longer get to enjoy the tax-free income stream. So if they were to fund it in 1 year, the guideline single premium, or GSP, is the maximum amount that you could put in the initial 11 years or so. See, since people wanted to fund in the GSP in the very first year, TAMRA required them to spread those funds over into 5 or 7 year time frame. See, when you or your life insurance agent are structuring a life insurance policy as a superior capital accumulation and tax-free income vehicle, it is crucial that you understand the tactics to lower the life insurance costs to accommodate that guideline single premium. See, many financial advisors or life insurance agents are not taught these strategies, nor do they understand them. So it is crucial that you work with someone that knows how to properly structure these type of policy so it could give you the optimum performance. See, when you have decided on the amount of money that you would like to put into one of these contracts over a specific time frame, we would then solve the death benefit that meets the TEFRA, DEFRA guideline by using sophisticated software. So you would then fund that premium into the policy as quickly as you can and as fast as the IRS will allow. Now, let's compare your index universal life policy into this bucket here. See, the size of the bucket is determined upon the amount of premium that you would like to put into your contract. And the death benefit that's going to be accommodated, that amount of premium at your specific age. Let's say that this particular bucket has the room for $250,000 premium. And with that, it's going to come a $550,000 minimum level death benefit. You could fully fund and fill up your bucket in just 5 equal payments of $50,000 over that 5-year time frame. And you will have a fully funded, max efficient, index universal life insurance policy. See, there are people that have the time or the capital and the cash flow in hand that they say, hey, I wanted to pay $50,000 for 10, 20, 30 years. Can we still do that? Well, what would that bucket look like? All you and your life insurance agent need to do is, instead of minimum level death benefit, you will have to change to minimum increasing death benefit. As you fund for 10, 20, 30 years, once you are done funding, you will then switch to level death benefit. Essentially, it's just a way of filling up your new bucket of money without having to purchase new policies every single time. See, both designs are maximum efficient. It's where we are squeezing down the policy cost and increasing your earning potential. Now, there are annual costs associated with your policy, and those costs including the pure cost of maintaining a life insurance policy or the death benefit, or there's any other fees associated with managing that policy. These costs and fees are represented down here at the bottom by these spigot. Before you view the outflow or the cost flow as a negative, because of this outflow, this properly structured life insurance policy can actually work for you. It's going to pay for that valuable life insurance death benefit that's going to your loved ones, or it's essentially watering this little money tree. And that's going to grow and transfer to your beneficiaries tax-free upon your passing. See, when you open an index universal life insurance policy or the bucket, you're going to want this spigot to drain the least amount as possible, so your internal rate of return is the highest possible. But please remember, cost and fee are not evil words. But because you have manageable cost, your capital can grow tax-free and potentially eliminate any future taxation. This is the key idea to properly fund your index universal life insurance policy with respect to this IRS guideline. I hope this information will help you understand the tax code history and how to utilize this wonderful financial tool to help you achieve your financial goals. And thank you for watching, and we will see you in the future episodes.